Well, Fed Chair Powell gave the green light to a September rate cut on Friday, noting at the Jackson Hole Symposium that the time has come for policy to adjust, seeing stocks rally to within inches of record highs while the dollar softened to its worst levels of the year. Another intriguing week now awaits market participants, with earnings from Nvidia on Wednesday, the standout risk event, along with inflation figures from the US, eurozone, and Australia, and a chunky slate of Treasury supply as well. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's get into the show. So it was another interesting week for financial markets last week, albeit one that I watched from the sofa or the beach. Fed Chair Powell, as I said, giving the green light to a September cut at the Jackson Hole Symposium. And joining me as always to make sense of everything that's going on is my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good morning to you. How are you this morning?
Yeah, I'm very good. Thank you very much, mate. Hope you are too. Had a nice little jolly up in Spain. Not too sunburnt, I see, but not much of a tan though. So just staying under an umbrella all the time, did you?
Well, mate, I mean, you will know this problem. When your hair's thinning out, you can't afford to spend too much time in the sun unless you've got a big Panama hat on. So, you can't be too careful these days, slapping the sunblock on like a cricketer. And although I do assure you, I did enjoy the sun, just sensibly.
Very good, very good. Yeah, you don't want to, got to watch the old ball pate, haven't you?
Absolutely, and it's certainly not going to grow back at this stage. So that's only going to
definitely
get worse
not.
As time
definitely
progresses.
not. Yeah.
Indeed. Maybe my next holiday will be to Turkey at some point. But anyway, let's move on into topical thunder and dig into what's been going on over the last 5 days or so. So I guess the main event from last week was the Jackson Hole Symposium. It wasn't just me having a holiday, but all the G10 central bankers as well, going over to Jackson Hole, Wyoming for some speeches, some lectures, and probably a spot of fishing and horseback riding while they were there as well. Of course, and plenty of that. Well, I can't talk either on that front, to be completely honest with you. Of course, it was Fed Chair Powell's speech on Friday afternoon, London time, that really stole the show. And Powell really took, I would say, a well-deserved victory lap, taking the last step in the Fed pivot and confirming that rate cuts are now on the very, very near horizon. The key lines from the speech were that the time has come for policy to adjust. And if that wasn't clear enough that cuts are on the way, Powell then said it explicitly, saying that the timing and the pace of rate cuts will depend on the data, the outlook, and the balance of risks to that outlook. The reason why the Fed are prepared to deliver a rate cut is simple. They now have confidence that inflation is indeed on a path towards 2%, while Powell also noted the other side of the dual mandate, saying that he does not seek or welcome any further cooling in the labour market. I would argue that that last remark is probably the most important in the remarks that Powell made, because it strengthens the Fed put. That is now contingent on the labour market. And Powell saying very, very clearly, if unemployment goes above 4.3% and the jobs market cools further from where it is at the moment, they will respond. And if needed, they will respond aggressively. And of course, given the work of the last 18 months or so, they have 525 basis points worth of room to respond if indeed they need to. I would also argue that that last remark is perhaps a tad more dovish than markets had been expecting, but it certainly doesn't take a genius to work out that those remarks nail on a rate cut in September. Of course, there was no pre-commitment to the magnitude or the pace or the scale of policy easing or normalization, and that now remains the main open question. And I would imagine that the August jobs report that we get on the 6th of September is going to be the key determinant of whether it is a 25 basis point move on the 18th of September, which remains my base case, or a 50 basis point move. Although personally, and I'm keen to get your view on this, Ryan, I think a 50 bip move at this stage, given the data we've got, would just smack of panic a little bit, given where inflation is as well.
Yeah, absolutely agree with that. I think base cases are 25 as well. They won't want to rush into anything, maybe seem, as you say, like they're panicking. What rate cuts do for the jobs market is anyone's guess, though. It's more the economy that needs to keep, firing, if you like, to keep jobs in play. So people are making this distinction between, what happens in the jobs market to what happens with rate cuts. But if we get a really stinky jobs market, they're not going to turn that around with a rate cut. It means there's more entrenched problems in the economy than perhaps they didn't know of before. That's what they'll try to affect. But the market's going to play this game all the way through now to the Fed meeting. We're going to get that jobs number. If it's a hot number, if it's a good number, then you're going to see those 50 BP expectations winding down and 25 pips favoured. We played this game after the last after the last NFP report, if you remember, when the market went a bit potty on that. I think really, given the rest of the data, jobless claims and housing market and stuff like that, we are seeing some softness in those sectors, but not the jobless claims numbers. So there's no real need for them to panic with a big move. But the NFP is the NFP, and it can come in minus 200k as easy as it can come in plus 200k. So you never know. We'll all be waiting for next week.
Yeah, absolutely. And of course, we didn't have time to discuss it when the data came out because one of us was away. It might have been Kyriakos that was away. And the uptick in unemployment that we saw in July to 4.3%, that was pretty much all driven by temporary weather-related layoffs. I think those unable to work for temporary reasons was something like the biggest month-on-month increase since the back end of 2020. Now, given that the Hurricane Beryl has now passed, you would expect those people are going to go back into work when we get the August data coming out. So that should see unemployment come a little bit lower and again support that stance that it is going to be a 25 basis point move instead. But anyway, looking ahead, Ryan, you're going to cast a downer on everything because I think you're going to tell us that summer is over.
Yes. Sorry, I'm not here to be party pooper, but yes, we for the UK at least, we're entering the last week of the summer holidays. The last pina coladas are being drunk, and the mad rush to buy school uniform is on for the new school year. And from next week, I think volatility is going to come back with a bang. We cross into September, and a month with 10 major central bank meetings. Among the major ones, there's plenty more on top of that, setting the tone really for the rest of the year and then going into 2025. It's a bit like the final months of the football season where all the prior months' activity leads up to the crunch time in the final few months.
And West Ham are battling against relegation once more.
Come off it. We're only 2 games in, mate. We'll see what happens 6 months down the line. But anyway, out of those 10 central banks, only the Fed, Norges and RBA have yet to start cuts, and only the Norges and RBA have still to signal rate cuts just yet. For the rest of the year, we're going to be trading the speed of future cuts and how big they might be. And it's important to remember where the finish line is for all the cuts. Central banks want to get to a normal, neutral rate, whatever you want to call it, which could be anywhere in the 2 to 3% range, maybe a bit more, maybe a bit less, with exceptions like the SNB, of course, who still got rates less than 2%. So we're really only looking for some 200 to 300 basis points of cuts, depending on the bank. Now, this is not the same as the hike cycle. Rates are going to come down roughly 50% of what they went up. That's important to know for our trading, and especially expectations, because it likely won't mean big moves if all the cuts start going to plan. Where the big moves will come from is if the data really starts turning sour, and cuts might have to be quicker or bigger and travel further than the neutral levels expected. That's what I think trading the latter part of 2024 is going to be all about, and it kicks off next week.
Indeed, yes. Well, thank you for that cheery message, Ryan. I mean, it's hardly been a summer for the record books here in the UK, although I'm sure we'll be told it was the hottest, driest month since the inception of the world, as is often the way. But yes, you are absolutely right. As we move back into September, traditionally for our US viewers, we think of Labor Day. Once we move past that, markets are out of their summer mode. And of course, the other thing that I can't believe I'm bringing this up, but I've got to, is, we're only a couple of months away now from election day in the United States. And of course, it is now Trump versus Harris. We've got the debates to come. Both will hopefully outline some more concrete policy positions. But one thing markets are very, very bad at is pricing political risk and political uncertainty. So not only only do we have the policy uncertainty to deal with, do central banks live up to and deliver the expected pace of easing that markets are pricing, but also the political uncertainty and how markets gyrate around the polling for the presidential election to deal with as well. And I think that's going to be a story, not just for the equity space in the United States, but really across the board.
Yeah, I look forward to your analysis on later trade-offs over the elections. You bugged me about pulling up the elections earlier this year, but I'm going to leave it all to you now for the rest of the year.
Oh, thanks, mate. Well, that's fine. It means we won't mention it now until the 5th of November when the result is known. Right, moving on to something that is happening in the much nearer future, and that is earnings from Nvidia, which are due after the market close on Wednesday. Of course, all the usual hyperbole surrounding Nvidia is getting back up and running once more, the most important stock in the world, the most important earnings release ever, etc., etc., etc. Of course, all of that is rather overdone, but it is nonetheless a key risk event for market participants to navigate. And the Nvidia report comes right at the end of US earnings season. We've now had 93% of the S&P 500 report earnings for the second quarter of 2024. 80% of those have beaten consensus EPS expectations, as has become a theme of earnings seasons recently. Companies massage expectations lower, and then, surprise, surprise, they beat those lower expectations. So take that stat with a little bit of a pinch of salt. One thing you shouldn't take with a pinch of salt, though, is that earnings growth at a blended rate of 10.9% is the highest rate since the fourth quarter of 2021. And of course, continued solid earnings growth is a key part of my equity bull case that has been running for most of the year. Arguably, though, the biggest earnings report is still to come, and that is, of course, Nvidia, where consensus sees the firm reporting EPS of 65 cents on 28.8 billion. The options market implies a huge 9.4% move to the up or the downside in the 24 hours following the report, which, when you do that on a market cap basis, is a frankly ridiculous $280 billion swing. I mean, some of the numbers associated with Nvidia are just crazy. Now, obviously, this is going to be a key catalyst for the market more broadly, and that's not only due to the index weights, Nvidia being, I think, the second largest in both the S&P and the Nasdaq, with a 6.5% and 8% weighting respectively, but also because, of course, the market remains laser focused on the tech sector and on this AI theme. And we've seen over the last 6, 8, 10 weeks, a little bit more skepticism begin to creep in, and risks around this AI theme become a little bit more two-sided. And I think market participants are becoming a little bit more doubtful as to whether these huge short-term investments that we've seen, not only from Nvidia, but from Meta, Microsoft, Apple, and whether they're going to actually pay off in any sort of reasonable time frame. So Nvidia earnings certainly one to keep on the radar for risk sentiment more broadly, as well as for the stock itself. But I do think, and we'll get onto this in a while, but any dips in the equity market do remain a buying opportunity. And I think for now, at least, the path of least resistance should, no matter what Nvidia say and whether they're the most important stock in the world or not, the path of least resistance should continue to lead higher for now.
Yeah, I think looking at it in its various parts, you mentioned the stats about the earnings, 80% beating. None of those stats suggest the Fed should start cutting by 50 basis points. I want to look at it in that context. But some of the forward guidance from some of the big companies hasn't been all that rosy, worries about the future. But we're not seeing big, massive declines in any sort of businesses. So, again, that for the Fed side and the trading side, that keeps that in check. On the other side, Nvidia, much as the rest of the Mag 7, they're out on their own universe. I mean, when you've got options markets pricing in a potential swing the size of some country's GDP, it just tells you we're in fairyland with some of these numbers. So whatever happens, it's either going to send the stock market up or it's going to send the stock market down. And I think you're quite correct. There's potentially a trading opportunity if we see, relatively weak numbers pushing the stock market down. The buyers are going to likely come hoovering it up. So maybe that's a fade trade to look at if such happens. Failing that, if it's good numbers, we're probably going to see all-time highs or fresh all-time highs in stock markets once again. Don't fight the trend.
Indeed, and we are not far away from those record highs. The Dow, the horrible, archaic thing that it is, which should have been retired long ago, that hit a record yesterday on Monday, and the S&P is less than 1% away from its own record. In any case, we do still have inflation to deal with this week, and there are perhaps a few spanners to be thrown in the works there.
Quite possibly. We have got some data this week that's going to tick some boxes or not for some of these central bank movements, cuts in September. US consumer confidence drops today and expected to come in pretty much unchanged at 100.2. The inflation expectations will be the most important aspect of this data. 1 year CPI expectations were 5.4% in July, and a decent drop there will add to the Fed cut picture for September. A hot number, though, could see a dip in that September pricing, which, again, might be worth a fade move if that move is big enough. On Thursday, Germany kicks off the eurozone inflation numbers for August. It starts with the regional numbers in the morning, followed by the pan-German number early afternoon. Now, there's been some talk here, about these base effects that we always hear about from last year, pushing inflation up in Germany into the latter part of this year. So we perhaps should be on watch for some high prints from there. Then on Friday, we get more individual eurozone inflation data as well as the pan-eurozone number, which again will add to or subtract from the expectations for the ECB September meeting. Now, in the US session, PCE data will be watched eagerly for whether it, again, cements a Fed cut or even maybe changes what size of cut it's going to be. But based on what Powell has said, I'm not sure if it will move the needle too much, because it seems whatever the number is going to be, we're heading towards a cut. But again, look for those trading moves, look for those potential fades if it's a hot one and dampens rate cut expectations. So for me and trading, fading moves against the narrative is pretty much how I'm going to be looking to trade data going into the September meeting. So I think there's going to be some opportunities if the data moves it away from the general market expectations.
Yes, I think that's a very good way to look at it. And I think fading some of the market pricing that we see at the moment is probably my preferred way to play it as well. A couple of things I would say. I think the inflation figures on this side of the Atlantic are probably more important, than the figures that we get from the United States. The reason I say that is because it seems the September cut, the magnitude of that cut from the Fed, is going to hinge on the labour market. The Fed have got that confidence that inflation is going back to 2%, and whether PCE comes in at 2.5, 2.6, 2.7, 2.8, doesn't seem like that's going to change their minds too much. I think the eurozone is much more interesting because we're all expecting, and the market is pricing 25 bips from the ECB in September, another 25 in December. But if you start to see inflation becoming a little bit more stubborn and a little bit more sticky, it's not going to take a lot for some of the hawks on the ECB Governing Council to actually start sounding the alarm and saying, do we just ease up on the pace of policy normalization a little bit? And of course, we had, after the July ECB meeting, those sources reports casting some doubt on whether they would cut twice more this year. And it does seem that groundswell of opinion, particularly when someone like Schnabel is one of the most influential members on the Governing Council, it's not going to take too much for the ECB to perhaps become a little bit more hawkish than the market expects. And it's only a fortnight or so until we have the pleasure of a Christine Lagarde press conference to hopefully clear all that up for us.
Yeah, I'm looking for the tan colour chart. So looking forward to the tan colour chart.
You'll be more tan than me, that's for sure.
Yeah, we'll have to put our tans on this time, and for hawkish or dovish. There's been plenty of ECB members, who have been saying that inflation might actually start rising into the latter part of the year. Now, whether that derails their cutting plans is yet to be seen. Hence why this data could be pretty important, as you say, because it is going to make that decision for them. So I wouldn't be surprised if we do see some hotter numbers, but then again, they could just be covering their arse and saying, yes, we expect it to go up, but if it doesn't, well, fine, we'll carry on cutting. So you got to remember, they got caught out on the way up. They're certainly not going to get caught out on the way down.
Well, I love the faith that you're putting in policymakers there. I can't say that is a shared view. In any case, let's move on to some charts in That's a Setup. Right, I'm going to kick things off with a look at the dollar. And there's something that I need to address because I've had 1 week away from the desk. And it seems like the lunatics have taken over the asylum. I must admit, I did have a quick look at where the dollar was while I was sat there sipping a nice cold beer last week. And I had to do about a triple take to make sure that I was actually seeing this chart correctly, with the dollar index trading to fresh year-to-date lows on Friday and bouncing off that level yesterday. And the move seems very overdone in my mind, given that it appears to have been driven by Fed Chair Powell having stood up and pretty much said exactly what we all knew he was going to say. And certainly market pricing, when you look at what the market is pricing for the Fed, it also appears far too aggressive. The OIS curve discounting around 100 basis points worth of cuts by December. And of course, remember, there are only 3 more Fed meetings this year. So that implies that at least one of those is going to see a 50 basis point cut. And then beyond that, by next July, the OIS curve prices an almost ridiculous 200 basis points worth of easing. So the market is effectively saying that by, well, this time next year, the Fed will have normalized policy back to its neutral level, which in my mind seems a little bit ridiculous and would take a huge exogenous shock for that to actually happen. I think the Fed are going to take a much more cautious approach to easing policy than that, particularly when you take into account, as we discussed earlier, the relatively one-off nature of the rise in unemployment that we saw in July, and the fact, as Ryan alluded to in terms of earnings, but also economic growth in the United States. The economy's grown by north of 2% on an annualized basis in 7 of the last 8 quarters. There is not particularly much out there that says the Fed needs to ease that aggressively. US economic growth continues to outperform its peers. So this is a little bit of a fade the aggressive policy expectations trade and buy into the US economic growth story. And I think the dollar index is due for a bounce.
Yeah, I think I can agree with that. Similarly, I'm thinking the same, that perhaps, well, when we trade in central banks, always trade in the expectations, and the market doves have been chasing the Fed cut all year, and they've come up short. This time they've got their confirmation, so perhaps this has been a bit of a last move in the dollar and elsewhere. So I think it has the potential for now to be the end of the game as far as this dollar move is concerned, but we're all back to watching the data and seeing what the size of the cuts may be, and that's what we're going to be playing. So for the dollar, it does look like a bit of an overextension for now. You know, we can always go further. Markets can always stay far more irrational than we can stay solvent, as the saying goes.
Yes, of course, that is absolutely true. And I think if we do break those, the December 23 lows and also this year's lows around 100.6, then that could obviously open the door to further downside. But we will see what happens. We're going to have a foray into the Treasury market first, though.
Yeah, very much. We're going to look at 2-year yields. I'm going to look at 2-year yields here, because I think there's maybe a bit more room for some downsides. While we've seen the dollar has had a bit of perhaps a last hurrah sell-off, Powell has pretty much given the green light to the cut. Yields haven't really joined in, which suggests they've perhaps already had their pricing moment. That we haven't seen yields drop to levels following that last NFP report adds to that theory also. So even with this Powell confirmation, we haven't seen something like the 2-year yields get down to those prior lows. Now, the obvious caveat here is that yields don't just purely directly reflect central bank rate levels, and that applies here. But if you work on the basis that the Fed might cut to maybe around 3%, some sort of neutral level, that's around 225 basis points of cuts over the next, call it 17, 24 months, whatever. That makes the 2-year yield still near 4%, perhaps a bit rich. Now, I've been advocating buying decent dips in bonds on prior trade-offs, and I still think there's maybe some value buying decent price dips here in twos on the back of where rates may go eventually. So I think around here, the 4% mark, we should possibly be trading maybe a bit lower down towards that 370, 380, 350 area at some point.
Yeah, I don't necessarily disagree with that. I don't have a particularly high conviction view on the Treasury market at the moment. The one thing I would say is, obviously, if we do see the front end continue to rally and yields continuing to come lower, that is, of course, going to continue to narrow some of the rate differentials that we see. Of course, the main one being the Treasury JGB spread, both at 2-year and the 10-year, whatever you want to watch. And you just wonder to what degree there may be any further well, not necessarily carry unwind, because I think that's probably mostly done by now, but perhaps a further intention for market participants to be short dollar yen as a result of that narrowing differential, particularly as there seemed to be some relatively hawkish rhetoric from the BOJ of late as well.
Yeah, I'll absolutely agree with that as well. And again, just to make that distinction between bonds and other markets, it's often the bond market that has the calm effect on things, even though over the last couple of years it's been an absolute roller coaster now and again. But yeah, you can use bonds for a lot of reasons. Obviously, you've got the curve and what it means, inversions and the like. But yeah, keep your eye on these yields just as one aspect of where the market is sort of pricing rate expectations, because again, that potentially gives us another trading opportunity.
Yes, indeed. Right, moving on to another one that I think has gone a little bit too far, too fast, and that is cable. Again, doing a bit of a double take on this when I was sat around last week seeing alerts popping off that cable had risen north of 132 for the first time in, well over a year. Again, there seems relatively little to justify this sort of a move. I mean, clearly it's a dollar-led move with that weakness that we saw in the greenback and that we discussed a moment ago. That the pound really doesn't have particularly much going for it at the moment. The labour market is continuing to soften, although we do have very unreliable data on the labour market. And I saw an interesting story last week, Ryan, that, you know, the ONS, they keep delaying and delaying and delaying the release of the new labour force survey. Well, their dedicated staff have now decided that they're not going to work any overtime because they're being asked to go to the office 2 days a week. So, you know, you wonder why we're in such a shambles in this country with our statistics. I think that tells you everything you need to know. Anyway, going back to this chart before I turn this into a complete rant, the labour market is continuing to loosen. The growth backdrop remains relatively fragile. There are increasing signs that consumers are showing a little bit more restraint when it comes to spending. And of course, you've got the big potential headwind looming over the market, which is the budget in October, where we're likely to see a fairly dramatic and significant tightening in fiscal policy. Of course, the Chancellor, Rachel Reeves, has said that we've got this £22 billion black hole that needs to be plugged. Yes, it's completely made up, but yes, she's also going to do something to supposedly plug the thing that's made up. So good luck getting your head around that. The long and the short of it is that we are going to see taxes rise. We are going to see government spending slow significantly, and that should, you would expect, put a bit of a break in the economy. And once again, we see the Treasury starting to shoot themselves in the foot. One thing I did just want to mention, though, is in terms of the speed of the recent gains, it has been quite rapid and a bit too rapid for my liking. Cable spot is now 4% above the 200-day moving average, which is the yellow line you see on the chart there, which is the widest spread since August of 2023. And cable is also around 3% above the 50-day moving average, which is the most since December of 2023. So not only do you have a market that's gone a little bit too far too fast, a bit of a mean reversion play, but you've also got the increasing fiscal headwinds that I think are likely to bring cable back down to earth towards the 130 figure in relatively short.
Well, I don't know what to be more shocked about, the fact that cable's up near 132, or you're doing analysis on technical analysis now, saying how many percent we are away from moving averages. You've changed, mate.
That's where it is.
You've changed, mate. You know, what next?
I'm going to be doing how far away we are from an Elliott wave next week. Just you wait.
I can't wait for that. I saw your tweet yesterday as well on what was it, on the Bollinger Band and the Fed balance sheet? And I was like,
Bollinger Bands on the Fed balance sheet. Give me strength.
Anyway, before we end up down that road, I think I'm going to disagree slightly. I think the data has been slightly better for the UK pretty recently, for the last few months, than some of the cousins in Europe, particularly the PMIs that we got last week. So there are reasons why the pound perhaps should outperform some of the other currencies. We're not falling into quite the fiery hole that everyone usually expects us to, keeping our head above water, or nose above water, shall we say. But I think this is a definite speed thing. We know what cable's like. If we see something like the euro dollar moving 20 pips, this is going to move 40, 50 pips in the same breath. So there's a bit of volatility here. Same as we've been talking for the dollar in general. This could be a bit of a stretch move, just the last move on Powell. Now the market will settle in back down into what comes next, and as again the size of rate hike. So enjoy it perhaps while it lasts.
Yes, indeed. Well, you mentioned those PMI surveys. It's almost like we planned this show because euro sterling could be the perfect way to express that divergence.
Yeah, very much so. And we're all about surprises today. And I was pretty surprised that we were back under 85 pence when we saw it before. It's been quite a volatile ride recently. We went from testing the 84 level to zooming right up to the 86. And now we might be heading back to the 84 again. A couple of trade-offs ago, I said the 85 level might be worth looking at for shorts, but that wasn't to be. I got trailed out the balance of my price shorts from there that I took on early July. Now, it might not be a surprise to some of you to learn I'm short from the 86s as that was my next big level above. But as I say, what has me surprised is this fairly easy move back under the 85, 84, 80 zone. And the way that it's already begun to become resistance around the 84, 80. That suggests we might be in for another move to this 84, 83, 80s support. And if so, I'm going to consider exiting my remaining shorts and potentially turning long. Now, if you want to play a pair that really plays nicely with the levels and isn't often volatile, this can be the one to watch. But be mindful of when the moves are because of fundamental reasons, or as I just mentioned, purely on the fact that cable, pounds, dollar moves faster than euro dollar, particularly when the dollar is the driver in those. That's likely a big reason why we've made this big leg down under 0.85 at the moment. So we've got a good range to play here. 0.85 is really your resistance area. We get to see whether we're going to get a test of this 84 area.
Yes, I think that's a very important point, considering both the implied and the realised volatility of the pairs that are involved here, because of course euro sterling is just a triangulation of cable and euro dollar. But yes, although I think cable has gone a little bit too far too fast, I think further downside in euro sterling is perhaps warranted, particularly when you consider the BOE. There's still four MPC members who don't think it's actually appropriate to deliver a rate cut yet. So the bar for another cut from the from the BOE, this is turning into a shambles, is probably much higher than the bar for another cut from the ECB. So if that makes sense to anyone, great.
It sort of makes sense to me. As I'm going to mention in my play of the day, what you need to look for here is what's happening with euro dollar at 112. It's a big, huge level up here. I won't give too much away. As I say, it's my play of the day. But that could be a reason why we test that low area. If that 112 holds while cable keeps going, we might get a test there. And then if the pressure mounts on dollar sterling, that 112 breaks, then there may be a bit of catch up, hence why that level might hold.
Indeed, yes, we will not spoil your thunder, and we'll let you cover that in a moment. And indeed, let's move on to our plays of the day. Good stuff. Right. I'm going to kick things off with a look at the US equity space. I still think the broader direction of travel is higher for the US market and for the market globally, but just looking at things through a slightly different lens this week, because I think there is a little bit of a short-term case for some of the small cap stocks to start outperforming. And indeed, we did actually see this yesterday with the NASDAQ closing around 1% lower and the Russell closing around 0.25% higher. Why do I think that? Well, I think the market is laser focused on the Fed cutting rates in September at this moment in time. And you've got to remember that around half the Russell is made up of pretty unprofitable firms and frankly junk. And I think a lot of this junk could begin to squeeze higher over the next week, maybe 2 weeks, as a result of the market becoming increasingly sure that the Fed will cut rates in September, on the 18th of September. So I'm going to express this long Russell, short S&P as a bit of a spread. You could do long Russell, short NASDAQ if you wanted to. But again, just to emphasize, I think this is a very, very, well, for me, a very, very short-term position. It's something I would only want to hold for a couple of weeks at most and probably look to get out of before the non-farm payrolls print on the 6th of September. Just to eliminate any potential hawkish risks. Ryan, you're going to look at the euro, and of course, the first thing to mention is, well, I lost our bet, didn't I?
Oh, I forgot to mention that, didn't I? Oh, well, I'm
Well,
glad you
you
brought it
very
up.
charitably said I don't have to pay up, so
Yeah, well, I'll let you off one.
I've got it in writing. Don't you worry.
Yeah, exactly. But yeah, we had our little bet. What was going to come first, 111 or 105? I picked 111. You picked 105. I think I even gave you a couple hundred pips head start on that one.
You did,
Um,
yeah.
But you came close. We both came close now and again, but it finally went. So yeah, another feather in the cap for our battle there. And yeah, McDonald's it is, mate. If I'm paying, so
Oh,
better be up there. I think they've got 3 for £3 on the menu. So yeah, we'll get in quick. But no, I'll take you out for lunch, mate. Always going to be a pleasure. Anyway, back to trading and euro dollar is this one. And as I said, we've got some huge levels up top here. Now, my play of the day in the last trade was looking to short up into the 110, 111 range. If I like the reasons why we were there, well, I wasn't okay with those reasons. So after that, I left it alone. We were going into Powell and that farce of an NFP revision that was absolutely hilarious. However, this break of the 110, 111 range top has seen us hit another massive level at 112, which comes ahead of an even bigger level at 115. Now, these are multi-year levels that you do need to pay attention to. They are absolutely huge. I'm already short at 112, and that level may continue to offer sellers an opportunity. I'm going to be looking to add to my current position or maybe take a fresh short into the 61.8 fib at 112.75, which again is a big level itself. Now, if we have seen the last sell-off in the dollar on the back of the Fed, these are the sort of levels that would mark good stretch points, and I'll be looking for a move back down to 111 or maybe even through to 110 and the low 110s. So if we do manage to hold up here for a decent period of time, I would expect to see a pullback. So as I say, there's still maybe opportunities to tap a test of 112 if it comes.
good stuff. Thank you, mate. I look forward to our lunch somewhere slightly more upmarket than a McDonald's, maybe a Pizza Hut or somewhere like that. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, and also to our producer, Kyriakos, for bringing things together as brilliantly as always. As Ryan so happily said earlier in the show, summer is now over, so we're back to doing the trade-off every week. So we will indeed see you again next Tuesday. In the meantime, thank you very much indeed for watching. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know your thoughts and also anything you'd like us to discuss in the show next week. And we will see you in a week's time. Thanks as always for watching, and goodbye.